In the great arena of speculation, it is not the charts, the indicators, or the complicated systems that separate the winners from the failures. It is the ability to understand what drives the market at its very core, human behavior. Markets are nothing more than the collective mind of millions of men and women moved by greed, fear, hope, and desperation. The ticker does not pulse with numbers, it breathes with emotion. Those who see beyond price and glimpse the psychology behind it, those who can feel the market's mood like a pulse under their fingertips, are the ones who walk away richer in both profit and wisdom. Every trader comes into the market thinking that success lies in mastering the mechanics. They believe if they can only find the right chart pattern, the perfect formula, or the secret indicator, the market will yield its riches. They forget that the market has no obligation to behave logically. It does not move in neat equations. It moves in waves of emotion. The very same pattern that once signaled a breakout will, under different psychological conditions, lead to a complete collapse. The difference is not in the formation, but in the sentiment surrounding it. When the crowd grows confident, the prices rise not because of intrinsic value, but because confidence itself has value. Traders buy not stocks, they buy belief. And when fear creeps in, belief evaporates faster than profit. The winners recognize these emotional shifts, not by studying mathematical precision, but by feeling the rhythm of the crowd. They know when enthusiasm turns into euphoria, when caution turns into panic, and when silence before the storm turns into opportunity. A trader who masters psychology learns to read between the lines of price movement. When the crowd grows restless, he senses the tension in the air long before it shows up in volume. When the news is good but prices hesitate, he doesn't need an explanation. He knows that the market's mood is changing. He understands that markets are mirrors reflecting the collective emotion of its participants, and he trades accordingly. He doesn't argue with it. He doesn't demand logic from it. He simply observes, adapts, and acts. The failures, on the other hand, are slaves to mechanics. They search endlessly for systems to predict the unpredictable. They rely on formulas and forget that those formulas are powerless against mass hysteria. They buy when indicators flash oversold, ignoring that fear can drive prices far beyond rational limits. They sell when charts appear overbought, not realizing that greed can stretch valuations into absurdity. They are students of structure but strangers to sentiment, and so they drown in their own data. The market is a living organism. It breathes in waves of optimism and exhales in cycles of despair. The price is merely the surface. Underneath lies the ocean of psychology. Every rally begins not with a chart signal, but with a spark of belief. Every crash starts not with bad numbers, but with broken confidence. Those who can interpret this emotional current can ride the waves instead of being crushed by them. The winners trade not against the crowd, but with an awareness of it. They do not chase price, they anticipate behavior. This understanding does not come from books or formulas. It comes from observation. To feel the market's psychology, a trader must live through its extremes. He must taste both triumph and defeat. He must recognize the smell of panic and the sound of overconfidence. He must remember how it feels when every trade seems destined to win, and how cold the room feels when every position bleeds red. Through these experiences, he begins to sense that price is not an external entity. It is a reflection of his own mind, multiplied by millions. The essence of trading lies in mastering oneself. If the market is a mirror of collective psychology, then your own mind is a microcosm of it. Every weakness within you, impatience, greed, fear, will be magnified by the market. When the crowd panics, you will feel that panic, unless you've trained yourself to remain detached. When the crowd grows euphoric, you will feel tempted to join them unless you've disciplined your emotions. The winners do not conquer the market. They conquer themselves. They observe their reactions as they would observe price movements, with calm awareness and no attachment. Consider a rally in full swing. The average trader sees opportunity. He buys because everyone else is buying. The wise trader watches, knowing that mass enthusiasm often marks the final stages of a move. He senses that the psychology of the crowd has shifted from rational optimism to blind faith. He waits for the first sign of hesitation, for that subtle change in tone when excitement turns to unease. He knows that the market often peaks when the last skeptic becomes a believer. This is not knowledge derived from a chart. It's intuition born from understanding mass behavior. Likewise, in times of panic, when prices plunge and headlines scream disaster, the crowd sells not out of reason, but out of survival instinct. Fear becomes contagious. Yet, the experienced trader sees opportunity in that chaos. He doesn't rush in blindly. He waits for the fear to reach its climax, for the moment when sellers are exhausted. He senses when despair has reached its peak, because he knows that markets, like emotions, cannot sustain extremes forever. When fear reaches its absolute, courage becomes cheap and profit becomes possible. The difference between winners and failures lies in perception. Failures see the market as an external battle, a place to fight, conquer, or outsmart. Winners see it as a reflection, a place to observe, adapt, and align. The former are driven by the need to be right, the latter by the desire to be in sync. When you trade to prove your intellect, the market will humble you. When you trade to understand its psychology, the market will reward you. There is also an irony in market psychology. While it is shaped by millions, it behaves like one mind. That collective mind follows predictable cycles of optimism and pessimism, greed and fear. Understanding these cycles is like understanding the tides. You cannot stop them, but you can prepare for their flow. The crowd will always overreact, both upward and downward. Knowing this allows you to position yourself where the emotional pendulum is about to swing back. The key is not prediction, but perception. Many traders fail because they want certainty. They crave assurance that the next move will go their way. But markets are built on uncertainty. It is the only constant. Those who accept this truth and focus on reading the psychological tone rather than chasing precision find freedom. They stop asking what will the market do next and start asking what is the market feeling right now. That subtle shift in question transforms trading from gambling to mastery. Understanding market psychology also means recognizing manipulation. There are moments when large operators exploit public emotion to their advantage. When the crowd grows overly bullish, professionals quietly distribute. When fear dominates, they quietly accumulate. The amateur trader thinks in price. The professional thinks in sentiment. To see what the market's largest players are doing, one must read the mood of the masses. They move opposite to it. The crowd sells to the strong and buys from the strong, and thus the cycle repeats endlessly. In the end, what separates the winners from failures is not access to information, but interpretation of emotion. Every price movement tells a story not of numbers, but of hope and fear intertwined. The winners have learned to listen to that story without judgment, to read the market's tone like a seasoned psychologist reads a patient's mind. They know that while prices change daily, human nature does not. The same impulses that drove speculation a century ago drive it today. Greed, fear, impatience, and overconfidence. To master these is to master the market. And so, while others search for mechanical certainty in an uncertain world, the true speculator learns to dance with emotion itself. He learns that the market's greatest secret is not hidden in the charts or the headlines. It is hidden in the minds of those who move it. Once you understand that, you stop reacting to price and start anticipating behavior. The market becomes less of a mystery and more of a mirror, reflecting back not what you know, but who you are. In the market, time is not an enemy. It is the most powerful ally of those who know how to wait. Most traders lose not because they lack intelligence, but because they lack patience. They want action every hour, movement every minute, and results every day. Yet the market rewards not the restless, but the patient observer who waits for the perfect moment to act. The true art of speculation lies not in constant activity, but in disciplined inactivity. It is in waiting for the conditions that align perfectly with your judgment and conviction. There are times when the market speaks in whispers. It doesn't move much. Prices seem to drift aimlessly. The inexperienced trader interprets this silence as boredom, as wasted opportunity. He forces trades to feel alive, to feel engaged. But the wise trader knows that inactivity is often the most profitable state of all. He understands that the market is merely preparing for its next great move, and his capital is safest and most valuable when it is waiting patiently for that moment to arrive. Just as a hunter doesn't fire at every rustle in the bushes, a trader doesn't strike at every fluctuation on the ticker. Patience is more than just waiting. It is strategic waiting. It is the ability to resist the temptation of small, meaningless movements in pursuit of the larger, decisive swing. Most fortunes in the market are not made by buying at every dip and selling at every rise. They are made by holding positions during the major moves and sitting tight through the noise in between. The impatient trader jumps in and out, collecting small profits that disappear in commissions and bad timing, while the patient one rides the great wave from start to finish. The irony of the market is that those who do less often make more. A trader must understand that there are two kinds of waiting in this game. The first is waiting for the right moment to enter. The second, and far more difficult, is waiting after you are already in position. Most traders can stay patient before they act. Very few can remain patient after they act. They watch their positions tick up and down, and their emotions follow every minor fluctuation. They feel an uncontrollable urge to do something, to take profits too soon or cut out at the first sign of weakness. The successful trader, on the other hand, remains as calm during holding as he was during watching. He knows that real profits require time to unfold, and time punishes the anxious. Markets are designed to test your patience. They move just enough to make you doubt your judgment, to tempt you to act prematurely. A position that looks perfect one day might appear doomed the next. The inexperienced trader responds to these fluctuations as if they were meaningful, constantly shifting his stance in a dance of insecurity. The experienced one sees through the market's tricks. He knows that the market feeds on the impatience of others. Every time an emotional trader exits too early or enters too soon, the patient trader quietly collects the reward of his discipline. Patience is not inaction. It is the most deliberate form of action. It takes far greater courage to wait for the right setup than to rush into a trade. The crowd equates movement with progress, but the market often punishes movement. To wait is to resist the urge to seek validation through activity. It is to stand apart from the noise and trust your plan when everyone else is reacting. Patience demands conviction, and conviction is built through observation, experience, and the calm understanding that opportunities in the market are never truly lost. They simply reappear under different forms for those who wait. There is a rhythm to every market. It expands and contracts, trends and consolidates. The patient trader studies this rhythm the way a sailor studies the wind. He knows that there are times when the tide is favorable and times when it is treacherous. When the sea is still, he does not row harder. He waits for the wind to return. The market is no different. There are seasons of opportunity and seasons of uncertainty. The failure tries to trade through them all, exhausting himself in the process. The winner conserves his capital and his energy for when the odds are overwhelming in his favor. One of the greatest mistakes traders make is confusing activity with profitability. They believe that to make more, they must trade more. But the market is not a wage-paying employer. It does not reward effort. It rewards timing. You cannot force it to deliver returns on your schedule. The market pays only when the conditions are right, and those conditions appear rarely. The patient trader understands this truth deeply. He does not need to be in the market every day. He knows that 1 or 2 great moves a year can yield more than 100 small trades. He is content to wait for the few moments that truly matter. Patience also means enduring discomfort. The waiting period between a good setup and the payoff can feel agonizing. Prices may move sideways for days, even weeks, testing the trader's resolve. The crowd will mock your stillness, calling you hesitant or slow. Yet those who cannot endure boredom will always pay those who can. The market's greatest secret is that boredom is often the precursor to opportunity. When everyone else grows restless and abandons discipline, the patient few remain ready to strike the moment the tide turns. The hardest patience is not in waiting for opportunities, but in holding them. Once a position begins to move in your favor, the temptation to take profits too soon becomes immense. The market will tease you with small gains, whispering that it is safer to cash out now rather than risk losing what you've earned. Many traders succumb to this whisper and exit early, only to watch the price soar in the direction they had predicted. They forget that the market rewards big moves, not small ones, and big moves require time. The patient trader sits tight, unmoved by temporary retracements, knowing that noise is not reversal. He understands that wealth in trading is built not by frequent winning, but by letting the few big wins mature fully. True patience is born of understanding, not passivity. You cannot wait properly unless you know what you are waiting for. The patient trader has studied the market long enough to recognize the conditions that precede major moves. He knows the difference between a dead market and a resting one. He can sense when accumulation is occurring under quiet price action, when distribution is taking place under deceptive strength. He waits for confirmation not from tips or rumors, but from the market's own behavior. And when the time comes, he acts swiftly, without hesitation, because patience has prepared him for that exact moment. The impatient trader, by contrast, is always at war with time. He buys too early, sells too early, changes direction too often. He spends his energy trying to control something that cannot be controlled. His impatience leads to constant exposure, and constant exposure leads to constant risk. The patient trader knows that risk is not just about losing money. It is about losing opportunity through overactivity. Every unnecessary trade diminishes clarity. Every impulsive action blurs judgment. Patience preserves both. Waiting also builds psychological strength. In a game dominated by emotion, patience is a shield against the twin enemies of fear and greed. When you can wait without anxiety, you no longer trade out of fear of missing out or fear of loss. You trade from a place of clarity. The crowd rushes into every move, terrified of being left behind. The patient trader stands apart, knowing that the market will always offer another chance. By refusing to chase, he preserves his most valuable asset, emotional equilibrium. The longer you can wait calmly, the more control you have, not just over your trades, but over yourself. There are moments when the best trade is no trade at all. The professional understands this truth intimately. He does not measure success by how many trades he makes, but by how well he aligns himself with opportunity. He can sit idle for weeks, even months, without losing confidence. He knows that inaction is not laziness, it is strategy. The crowd despises stillness because it feels powerless. The winner embraces stillness because he understands that power lies in restraint. The market cannot manipulate a man who refuses to be hurried. Patience is also the foundation of perspective. It allows the trader to see the market not as a series of isolated events, but as a continuous story. The impatient trader reacts to every chapter as if it were the ending. The patient one reads the whole narrative, knowing that what matters is not today's movement, but the trend unfolding across time. Through patience, he connects the dots others miss. He sees patterns forming, momentum building, psychology shifting, all things invisible to those trapped in the noise of the moment. A man who cannot wait for profit is not truly trading, he is gambling with time. The market is a vast ocean, and time is its current. You cannot swim against it, you can only position yourself so that when the current shifts, you are carried with it. Patience is the discipline that keeps you from thrashing aimlessly in calm waters. It keeps your capital dry for when the tide finally turns in your favor. It is not passive, it is power in stillness, readiness disguised as calm confidence expressed through restraint. In the market, the first loss is often the smallest. It is the wound that stings but saves. The great truth that every successful trader must eventually accept is that losses are inevitable, but large losses are optional. Most traders destroy themselves not because they lose, but because they refuse to lose small. They hold on, they hope, they rationalize, and in doing so, they turn manageable setbacks into fatal disasters. The discipline to cut losses quickly is not merely a rule of trading. It is the law of survival and speculation. Without it, no system, no strategy, and no brilliance can save you. When a trader takes a position, he takes on risk. That risk is the cost of participation. But the problem arises when the trader becomes emotionally attached to the outcome. The moment emotion enters, judgment leaves. The market begins to move against him, and instead of accepting the signal as truth, he interprets it as temporary. He tells himself that the market is wrong, that his reasoning is sound, that he just needs to wait for a reversal. Yet the market does not care about his reasoning. It punishes stubbornness as ruthlessly as it rewards discipline. The inability to admit a mistake is the most expensive weakness a trader can possess. Cutting losses quickly requires a kind of strength that few possess. The strength to admit error without shame, to take pain without hesitation, to sacrifice pride for preservation. The average trader sees a small loss as failure. The experienced trader sees it as insurance. He knows that every trade carries uncertainty, and therefore every trade must have a clear exit. He does not rely on hope, for hope has no place in the market. Hope is the language of the losing trader, the whisper that says, "It will come back." The market loves to reward that whisper with ruin. Those who hope instead of act soon learn that the cost of indecision is far greater than the cost of discipline. The essence of cutting losses lies in respecting the market's verdict. The market is the final judge. It never argues, it never apologizes, it simply declares the truth through price. When a trade moves against you, it is the market telling you that your timing, your direction, or your assumption was wrong. There is no shame in that acknowledgement. Every trader will be wrong often. The difference between winners and failures is that the winners recognize their errors quickly, while the failures defend them stubbornly. The wise trader understands that the market will always offer another opportunity, but only if he still has the capital to seize it. There is a strange paradox in trading psychology. The smaller the loss, the harder it is for most traders to take it. A small loss feels trivial, easy to justify, holding through. It's just a minor dip, they tell themselves. It will turn around. But that small dip grows larger, and the pain begins to blur judgment. The trader moves his stop-loss lower, widening the leash on his own destruction. Each tick deeper into loss becomes harder to face, and so he waits. Hope replaces reason, and patience, so virtuous in profit, becomes poison in loss. Eventually the loss becomes unbearable, forcing an exit not by choice but by necessity. By the time he surrenders, it is too late. What could have been a small scratch has become an amputation. The disciplined trader behaves differently. He enters every trade with a plan, a clear point of invalidation, where the market will tell him he is wrong. He doesn't move that point once it is set. He knows that protecting capital is not cowardice, it is courage. It takes courage to act when the crowd hesitates, to close a losing position while others cling to theirs. To the untrained mind, cutting a loss feels like defeat. To the professional, it feels like control. He knows that survival is the foundation of success. No one ever went broke taking small losses, but countless fortunes have vanished from refusing to take them. The market is a place of probabilities, not certainties. Every trade, no matter how well reasoned, carries the risk of being wrong. The trader who believes otherwise is destined to suffer. The market will humble every ego that dares to defy it. Cutting losses quickly is not about pessimism. It is about realism. It is the acknowledgement that no human mind can perfectly forecast the behavior of millions. The goal is not to be right every time, but to remain solvent long enough for the times you are right to matter. Every dollar preserved in a small loss is a soldier that can fight another day. Losses, if controlled, are teachers. Each small loss provides valuable feedback about timing, position sizing, or psychological weakness. But large losses teach nothing. They merely erase. The trader who cuts losses quickly keeps his learning curve alive. He treats every mistake as data, not drama. He does not take losses personally. He takes them professionally. He knows that a losing trade is not a reflection of his worth, only of his decision. Once the decision is proven wrong, he discards it without emotion, like a chess player abandoning a piece to save the game. Emotional detachment is essential. The longer you hold a losing position, the more personal it becomes. It stops being a trade and becomes a test of identity. You begin to argue with the market to defend your analysis, to justify your pain. But the market cannot hear you. The only language it speaks is price. The ability to step aside and say, "I was wrong," is the mark of maturity in trading. It is an admission not of defeat, but of discipline. For every minute spent defending a bad trade, you are wasting energy that could be used to identify the next good one. One of the cruel truths of the market is that small losses feel unnecessary until they become catastrophic. Many traders recall with regret the moments they ignored their stops, convinced that the market would turn just one more time. That single moment of hesitation becomes the seed of destruction. The market does not punish immediately. It seduces first. It allows the price to recover slightly, luring the trader deeper into hope until the real collapse begins. The patient predator waits for the stubborn prey to surrender, and when the surrender comes, it is total. The only antidote to this fate is the quick, clean act of cutting a loss before it has the chance to grow teeth. There is a rhythm to loss cutting that mirrors the rhythm of the market itself. The trader must act without hesitation, like a surgeon with a blade. Indecision costs precision. The longer you wait, the more emotion clouds the act. When the stop is hit, the decision has already been made. The act should be mechanical, unemotional, immediate. A trader who hesitates is like a soldier who questions the order in the middle of battle. Hesitation is fatal. The mind must be trained to view exits not as failures, but as executions of discipline. Only then does consistency emerge. Cutting losses quickly also preserves something more precious than capital: clarity. A losing position occupies mental space, draining focus and breeding anxiety. When you are trapped in hope, you cannot see the market clearly. Every tick becomes personal, every fluctuation emotional. By closing the losing trade, you release yourself from that prison. You regain objectivity. You can once again see the market as it is, not as you wish it to be. Freedom from attachment is not psychological comfort, it is strategic advantage. A trader who refuses to cut losses quickly becomes a collector of excuses. He blames manipulation, news, bad luck, anything but himself. Yet each excuse distances him further from truth. The professional does the opposite. He accepts blame instantly without self-pity. In doing so, he preserves his most important asset: self-trust. The more often you act decisively in the face of loss, the stronger your confidence becomes. You begin to trust your own discipline more than your predictions, and in a world ruled by uncertainty, that trust is everything. There is also a deeper layer to this rule, a philosophical one. Cutting losses is not just about protecting money. It is about protecting mental equilibrium. A trader who cannot bear a small loss will eventually face a large one that he cannot bear at all. Discipline in small things builds resilience for the larger storms. Each swift, controlled exit is a reminder that you are in command, not the market. You accept the unpredictability of the game, but refuse to surrender control over your actions. In a field driven by chaos, that control is your anchor. The practice of cutting losses quickly is also an act of respect. Respect for the market, for risk, and for yourself. It is the recognition that you are fallible, that no analysis is infallible, that the market's judgment is final. The crowd fears admitting error because it wounds their ego. The successful trader embraces it because it sharpens his edge. To survive in speculation, one must become a master of surrender, not surrender to fear, but to reality. And reality in trading is measured in price. In speculation, the hardest act is not entering a position, but holding it when it begins to work in your favor. Human nature resists patience in success. The mind whispers that profit should be protected, that a small gain is better than a possible loss. Yet the great fortunes of the market were not made by those who took profits too soon. They were made by those who had the courage to hold on when the move was right. The true art of trading lies not in constant buying and selling, but in the rare ability to sit tight while the market rewards your foresight. To ride a winner relentlessly requires not only skill, but emotional mastery, because it goes against every instinct of self-preservation that ordinary minds obey. When a trade begins to move in your favor, the temptation to close it early can be overwhelming. The market gives you a gift, and instinct tells you to grab it before it disappears. Yet every time a trader takes profit too soon, he exchanges the extraordinary for the ordinary. He gives up the chance to capture the rare, large move, the one that makes an entire year's worth of trading worthwhile, for the comfort of locking in something small and safe. The market's greatest rewards are not scattered across hundreds of trades. They are concentrated in a few decisive runs. Those who learn to stay with those moves until their natural end understand that patience is not passivity, it is power stretched over time. A winning position is more than just a line of profit on paper. It is proof that your judgment was right, that your reading of the market's rhythm aligned with reality. To cut that alignment short is to distrust your own intuition. A true trader must learn to trust his vision enough to let the market do its work. Prices once in motion tend to continue in motion until something meaningful intervenes. This simple truth, the tendency of trends to persist, has built more fortunes than any secret formula ever devised. Yet to benefit from it, one must resist the urge to interfere. A trader's greatest enemy is not the market's volatility, but his own impatience. The average trader treats profit like something fragile. He guards it too closely, terrified it will vanish. He forgets that the market rewards courage, not caution, when the odds are already in your favor. Once the tide begins to carry you, you must not step off the boat at the first wave. You must let the current take you as far as it can go. Every great market move begins quietly, builds momentum, then explodes into visibility. By the time the public notices, the move is half over. The professional is already there, not because he predicted perfectly, but because he had the patience to stay with his winner long enough for it to mature. There is a peculiar irony in trading psychology. The same traders who refuse to cut their losses quickly are often the first to cut their profits short. They let fear control both sides of their decisions. Fear of pain keeps them in losing trades, and fear of losing profit pushes them out of winning ones. They accept large losses and small gains, which is the exact inversion of how success is built. The professional does the opposite. He cuts losses without hesitation and holds winners without fear. He knows that one or two great moves can erase a dozen small mistakes, but only if he allows them to run their full course. To ride winners relentlessly, one must surrender the illusion of control. The market does not move according to your wishes. It unfolds according to its own rhythm. Once your position begins to move in your favor, your job is no longer to predict, it is to observe. You must become a witness to the unfolding momentum. If you intervene too soon, break the natural flow. The ego wants to take credit for the profit, but the disciplined trader knows that profits are not earned by prediction alone. They are earned by endurance. The market pays those who wait long enough for others to become impatient. The discipline to stay with a winner comes from understanding that trends are not random. They are reflections of mass psychology moving in one direction until exhaustion. The early part of a trend is slow and uncertain, filled with doubt and hesitation. The middle phase is powerful, where the market finally recognizes what you saw early. The final stage is manic, where everyone else joins and you begin to see signs of excess. The inexperienced trader sells too soon in the first stage, afraid the move won't last. The experienced trader holds through the second, harvesting the momentum while it lasts. He sells only when he sees the psychological climax, when greed replaces logic, and when the smart money begins to slip away silently. Riding a winner also requires emotional detachment from fluctuating profits. The market never moves in a straight line. Even the strongest trend breathes in and out. It rallies, pulls back, rallies again. Every pullback tests your conviction. Each retracement tempts you to believe that the move is over. But these temporary corrections are not signs of reversal. They are the market's way of shaking out the weak hands. The professional recognizes them as part of the journey. He does not flinch when the price dips against him. He observes whether the character of the move has truly changed. Only when the underlying structure breaks, the rhythm of higher highs and higher lows reverses, does he consider an exit. Until then, he holds with calm confidence. To ride winners relentlessly is to let logic triumph over emotion. It is the discipline to ignore the little profits flashing before you and to aim for the real movement that justifies the risk you took. Every trade begins with a risk-to-reward ratio in mind, but few traders honor it. They exit early and violate their own expectations. The professional respects the symmetry between risk and reward. If he risks 1 unit, he aims to make 3 or more. He understands that if he cuts losses quickly and rides winners fully, the mathematics of trading tilt naturally in his favor, even if he is right only half the time. The crowd, however, cannot bear the uncertainty of waiting. They crave the relief of closing a position and locking in gain. They sell not because the market tells them to, but because their nerves cannot handle the fluctuations. Yet that relief is temporary, and the regret that follows is long-lasting. Every trader remembers the trade they sold too soon, the stock that doubled after they left, the position that would have changed everything had they only waited. The lesson is always the same. Profit rewards patience, not panic. One must also understand the role of compounding in trading psychology. A small position held through a large move grows exponentially, not only in monetary value but in confidence and experience. Each time you ride a winner to its natural end, you train your mind to trust the process. to rely less on impulse and more on principle. It builds mental strength that no chart or indicator can teach. This is why some traders who make very few trades each year often outperform those who make dozens every month. Their success lies not in frequency, but in depth, in extracting the full potential of each opportunity. The greatest obstacle to riding winners is the illusion of foresight. Many traders believe they can time the perfect exit. They try to sell at the absolute top, to squeeze every last dollar from the move. This greed is just another form of fear. Fear of missing out on what could have been. The disciplined trader does not seek perfection. He seeks participation. He takes his cues from the market itself. When the character of the trend begins to shift, when volume dries up, momentum weakens and complacency replaces conviction, he prepares to step aside. But until that evidence appears, he holds with quiet determination. Holding a winner is not a passive act. It is an active form of discipline. It requires constant observation, emotional balance, and faith in your judgment. You must be comfortable watching profits fluctuate, knowing that the long-term reward outweighs the short-term noise. You must resist the false security of cashing out early. The market's greatest moves are designed to make the holder uncomfortable. That discomfort is a test, separating those who act on impulse from those who act on principle. Each wave of volatility is a question, and patience is the only correct answer. To ride winners relentlessly also means learning to let success expand naturally. Just as losses must be cut quickly, gains must be given room to grow. You cannot reap the rewards of a major trend if you treat every gain as a fragile thing to be protected. The professional scales out strategically, not emotionally. He might trim slightly as the move matures, but keeps the core of his position alive as long as the trend breathes. He knows that the market's big moves pay for all the small mistakes. It is these rare, powerful trends that separate mediocrity from mastery. There is a quiet confidence in those who hold their winners. They do not boast. They do not rush. They simply observe the unfolding of profit with the same calm they had when taking the trade. Their ego does not demand action. Their emotions do not dictate exits. They have transcended the need to feel in control and learned the art of surrendering to the market's rhythm. They are not gamblers chasing quick gratification. They are operators of patience, harvesting the rarest of rewards, the full potential of a correct judgment carried through to completion. The crowd, restless and impatient, cannot see the value of stillness in success. They sell because others sell. They cash in because others celebrate. And they leave the feast long before the table is empty. The disciplined trader does not follow the noise. He follows the logic of the move. He knows that the trend will end when the market decides, not when he grows tired of waiting. To ride winners relentlessly is to master yourself more than the market, to silence the urge to act when doing nothing is the most profitable act of all. In the great theater of the market, every opinion, every prediction, every rumor, and every headline eventually bends before one unshakable force: price. Price is the purest expression of truth in speculation. It does not lie, it does not flatter, and it does not explain. It simply moves. The market may whisper 1,000 stories, but only price tells the real one. Those who learn to listen to it without distortion, without bias, without ego, find themselves guided by the most reliable compass in all of trading. The tape, as it unfolds, speaks with a voice that is clear to those who have trained themselves to hear it. The moment you learn to read price action for what it is, not what you wish it to be, you begin to see the market as it truly is, not as the crowd imagines it. Every trader begins by searching for meaning in everything except price. They chase news, opinions, forecasts, and commentary. They listen to experts who promise to know the future. Yet none of these things have ever made the market move for long. The crowd forgets that all information, all emotion, all expectation, everything that can be known is already reflected in price. Price is the final verdict of the collective mind. It contains within it every hope and fear of every participant. When you look at a chart, you are not looking at numbers. You are looking at human psychology made visible. Every uptick is confidence. Every downtick is fear. Every sideways drift is hesitation. The tape is not mechanical. It is emotional poetry written in numbers. The greatest traders learned to read that poetry. They did not rely on opinions or predictions. They relied on observation. When prices rise steadily despite bad news, it means strength is hidden beneath the surface. When prices fall despite good news, it means weakness is quietly at work. These are truths that no analyst can tell you, no article can explain. They are truths the market reveals only through its own motion. Price action is not just about charts. It is about understanding behavior. The crowd speaks through its buying and selling, and the tape records its voice with perfect honesty. The reason price action holds such power is because it reflects the final synthesis of all available forces. Every trader, investor, institution, and speculator contributes to it. Their collective decisions based on fear, greed, logic, or ignorance form the movement you see. It is the most democratic and ruthless system in existence. The market cannot be deceived for long. Manipulation, rumors, and propaganda may distort perception temporarily, but the truth eventually emerges in price. A company may boast of strength. A government may promise stability. A guru may declare certainty, but if the price falls, none of it matters. The market's verdict is absolute. To understand price action, one must strip away ego. The mind always seeks confirmation of its own beliefs. When a trader takes a position, he begins to interpret every movement in a way that validates his choice. If the price goes against him, he calls it temporary. If it moves in his favor, he calls it proof. Yet price is indifferent to interpretation. It does not move to please or punish. It simply reveals where conviction outweighs doubt. The professional trader learns to observe price without personal attachment. He does not argue with it, he listens to it. If it confirms his idea, he rides with it. If it contradicts him, he steps aside. Pride has no place in that decision. Price action is the purest teacher because it strips away illusion. A trader can deceive himself with logic, analysis, or reasoning, but the tape confronts him with reality. When you are wrong, price tells you instantly. When you are right, it rewards you only if you have the courage to stay with it. The difference between winners and failures lies in how they respond to that truth. The loser argues with price, trying to impose his will upon it. The winner accepts it as the ultimate authority. The market never explains itself, and it never apologizes. It doesn't need to. Its movement is explanation enough. Learning to read price action is not about predicting the future. It is about interpreting the present. The crowd obsesses over what will happen next, while the professional studies what is happening now. The current price contains the seeds of the next move. The way it reacts to news, to volume, to time, all reveal the underlying tone of the market. Strength reveals itself not in words, but in behavior. Weakness exposes itself not in theories, but in hesitation. A stock that refuses to drop in bad conditions is telling you something. A market that cannot rise despite optimism is telling you something else. The tape always talks. Few have the patience to listen. The novice trader relies on external guidance because he fears uncertainty. He looks for predictions to give him confidence. Yet confidence built on opinion is fragile. Confidence built on price observation is unbreakable. When you learn to trust what you see instead of what you hear, you free yourself from dependence. You stop chasing tips and start interpreting truth. Price action teaches humility because it shows that markets move not on your timetable, but on their own. The wise trader does not try to control it. He synchronizes with it. To trust price action is also to accept that simplicity is superior to complexity. The crowd believes that success lies in advanced systems and secret indicators, but indicators are only derivatives of price. They are shadows of the truth, not the truth itself. Each layer of calculation adds distance between the trader and the market's voice. The closer you stay to raw price, the clearer your vision becomes. The clean lines of support and resistance, the rhythm of higher highs and higher lows, the tempo of volume, all these reveal the market's heartbeat. Complexity confuses, simplicity clarifies. The tape is simple because it must be. Its clarity comes from its honesty. The professional treats price as sacred data. He does not seek to predict where it will go next. He studies how it behaves. A sudden reversal after a prolonged rise tells him more than a dozen reports. A breakout that fails quickly tells him about exhaustion. The market telegraphs its intentions through behavior long before the headlines explain it. The crowd waits for confirmation from news. The professional finds confirmation in price. By the time the story reaches the public, the move is usually over. The tape always knows first. To follow price action also requires emotional control. The market's movements are designed to provoke response. It rises just enough to make you greedy, falls just enough to make you fearful, and oscillates just enough to make you doubt yourself. The untrained trader reacts to every motion. The trained trader interprets them. He recognizes traps when they appear as opportunities, and sees opportunity where others see noise. Price action, when understood, becomes a map through chaos, a living record of human emotion shifting between extremes. It tells you when to wait, when to act, and when to step aside. The market's greatest paradox is that everyone sees the same prices, but few see the same truth. Two traders can look at the same chart and draw opposite conclusions. What separates them is not information, but interpretation. The winner reads without bias, allowing price to tell its story. The loser projects his expectations, forcing the chart to agree with his narrative. One listens, the other argues. The market rewards listeners. There are times when price behaves irrationally, when it defies logic and expectation. These moments are where the untrained mind falters. But the professional understands that irrationality itself is part of the truth. The market is not governed by logic. It is governed by emotion. Price action captures that emotion with brutal accuracy. A panic sell-off is the physical manifestation of fear. A parabolic rise is greed made visible. These emotional extremes often mark turning points, but they cannot be identified by logic alone. They must be felt through the rhythm of price itself. Price action is not prediction. It is perception sharpened by discipline. It demands that you let go of the need to be right and focus instead on being aligned. It does not ask you to guess. It asks you to observe. The crowd seeks certainty, but the professional seeks clarity. Certainty is impossible. Clarity is achievable. The clearer your view of price, the more confident your actions become. You no longer chase. You respond. You no longer hope. You read. The market reveals itself, not to the loud, but to the patient watcher who has learned to listen through movement rather than words. The truth of price is cold but fair. It has no loyalty, no bias, no emotion. It reflects human nature in its purest form, imperfect, impulsive, and repetitive. That repetition is the key, because human behavior does not change. Price patterns repeat across decades. The same fear that drove a sell-off a century ago drives it today. The same greed that inflated past bubbles inflates the next one. The names and symbols change, but the rhythm remains eternal. When you study price long enough, you begin to recognize these rhythms instinctively. You no longer need explanation. You feel direction. The trader who embraces price as truth becomes immune to noise. He no longer cares what the market should do, only what it is doing. He measures strength and weakness not by commentary but by action. He lets the tape speak, and he listens in silence. He acts when the story is clear and steps back when it is confused. The market, in its purest form, rewards those who respect its truth and punishes those who deny it. To follow price action is to follow honesty itself, the unfiltered language of the crowd, written in motion across time. In speculation, the greatest enemy is not the market, not the news, not even the other traders. It is the self. The mind that cannot control its emotions is unfit to survive the endless storms of price and panic. Emotional control is the invisible thread that separates the survivor from the ruined, the professional from the dreamer. Every chart, every ticker, every trade is a mirror reflecting not only the market's movement, but the trader's inner state. The inexperienced believe success in speculation is about knowledge, strategy, or prediction. They study patterns and systems, but they neglect the most dangerous variable in the equation, their own emotion. Until a trader learns to master his impulses, no system, no wisdom, no secret can save him. Emotional control is not an advantage, it is a necessity. The market was built to test the limits of human emotion. It seduces with greed and terrifies with fear. It provokes overconfidence in winning streaks and despair in drawdowns. It whispers that this time is different, that reason can be ignored, that patience can be abandoned. The untrained mind obeys these whispers, chasing every rise, fleeing every fall. The result is always the same: loss of discipline, loss of capital, loss of confidence. The market does not destroy the undisciplined trader. He destroys himself. Every failure begins not with a bad trade, but with an emotional reaction disguised as a decision. To understand emotional control, one must first understand how the market manipulates emotion. The market is a living theater of human psychology. Every uptick stirs hope. Every downtick stirs fear. Every stagnation breeds doubt. The crowd's behavior follows this rhythm endlessly, rising from greed to euphoria, falling from fear to despair. This cycle is older than any trader alive. It repeats because human nature does not evolve as fast as prices do. What changes are the instruments, not the instincts. The trader who believes he can outsmart his own emotions is already defeated. The only path is to understand them, anticipate them, and discipline them before they act. Fear is the first emotion that must be conquered. Fear disguises itself as caution, as logic, even as wisdom. It whispers, "Take your profit now before it disappears," or "Don't take this trade, it might fail." Fear is the thief that robs traders of fortune more often than loss itself. It prevents them from acting when opportunity is real, and drives them to act when safety is illusion. A trader paralyzed by fear cannot seize advantage. He will always wait for confirmation, for perfect clarity that never comes. By the time he feels safe, the move is already gone. The market rewards courage, tempered by discipline, not fear, dressed as prudence. Fear blinds a trader to the present truth and traps him in imagined dangers. Greed, on the other hand, is fear's twin. It does not paralyze, it intoxicates. It whispers, "Stay longer, this move will never end," or "Double your position, this is your moment." Greed feeds on success and turns confidence into recklessness. The trader who cannot recognize greed within himself will confuse luck with skill and treat temporary gain as permanent wisdom. The moment greed takes control, the trader stops managing risk. He starts gambling. Every great ruin in the market has been born not from ignorance but from excess. The professional recognizes that profit is never owned until it is protected. Greed whispers promises of more, but it always ends in less. The art of emotional control lies in recognizing these internal voices before they command action. Every trader feels them. None are immune. The difference is that the professional observes them without obedience. He feels fear but does not act on it. He feels greed but does not indulge it. He becomes a detached observer of his own emotions, watching them pass like waves while he remains anchored to reason. The amateur believes emotions can be eliminated. The professional knows they must be managed. Suppression leads to eruption. Awareness leads to control. To trade successfully, one must remain calm when others panic and cautious when others celebrate. That is not talent. It is discipline. Discipline is not born in comfort. It is forged in loss. Every painful mistake, every emotional decision that ends in regret, teaches a lesson that cannot be learned from books. The trader who survives long enough learns that the market is not personal. It has no vendetta, no mercy, no intention. It merely reflects back what he brings to it. If he brings fear, he sees loss. If he brings greed, he sees ruin. If he brings calm observation, he finds rhythm. The market is a perfect mirror of emotion. Control yourself, and the market becomes manageable. Lose control, and it becomes chaos. Patience is the visible form of emotional control. It is the ability to wait without frustration, to act without hesitation, and to endure uncertainty without despair. The market often rewards those who do nothing when others are restless. But waiting is torture to the emotional trader. He equates inactivity with failure, forgetting that inaction is sometimes the most powerful action of all. The professional understands that opportunity must be earned by waiting for clarity. He does not trade to feel active. He trades to be effective. Patience is not passive. It is the quiet confidence that your moment will come, and that you will be ready when it does. Confidence, too, must be controlled. It is the most deceptive emotion because it masquerades as strength. Confidence built on discipline and observation is power. Confidence built on luck and momentum is poison. After a string of successful trades, the untrained mind begins to believe it has mastered the market. The trader becomes larger than the system, ignoring risk, dismissing caution. The market's response is swift and merciless. A single reversal, a single misstep, wipes away months of illusion. Confidence without humility becomes arrogance, and arrogance is the beginning of downfall. True confidence is quiet. It does not need to prove itself. It acts with calm certainty, not reckless pride. Emotional control also requires detachment from results. The market will not reward every correct decision immediately, nor will it punish every mistake at once. Sometimes good trades lose money, and bad trades make it. The emotional trader judges himself by outcome, while the professional judges himself by process. When success or failure begins to dictate emotion, discipline erodes. A trader who celebrates too much after a win becomes vulnerable to grief. A trader who despairs after a loss becomes paralyzed by fear. The only solution is detachment, to treat every trade as one step in an endless series, not a personal verdict. The market does not care who you are. It only measures how you behave. To maintain emotional control, the trader must also control environment. Markets are loud with opinions, noise, and endless commentary. Each voice seeks to provoke emotion, panic, hope, urgency. The wise trader filters all of it out. He limits exposure to information that has no bearing on his plan. He does not chase tips or trends because he knows they ignite the emotional spark that destroys logic. The less noise he allows, the more clearly he can hear his own discipline. Silence becomes a weapon against chaos. Isolation, far from being weakness, becomes strength. Routine is another pillar of emotional mastery. A trader who relies on impulse will always be a slave to mood. Routine provides structure when emotion seeks to break it. The professional begins and ends each day with defined habits, reviewing charts, setting stops, studying outcomes, not because routine guarantees success, but because it builds stability. Emotional storms lose their power against structure. When everything feels uncertain, a steady process becomes the anchor. Consistency in behavior breeds consistency in results. Even when markets are erratic, the amateur improvises, the professional adheres. Even with all this, emotional control is never permanent. It must be renewed every day. Each session is a new battle between reason and impulse. The trader must remain vigilant, watching for signs of fatigue, frustration, or overconfidence. When these emotions appear, he steps back, he reduces position size, takes breaks, resets his focus. Pride would rather fight. Discipline would rather wait. Knowing when not to trade is as important as knowing when to act. The ability to withdraw is not weakness. It is the highest form of control. The essence of trading is decision-making under uncertainty. Emotional control is the ability to make those decisions without distortion. It is not about being emotionless. It is about preventing emotion from becoming the decision maker. The crowd follows feeling. The professional follows plan. The market rewards those who can act rationally in irrational times. Every major opportunity arises when others are blinded by emotion. The trader who keeps his composure sees clearly while the crowd trembles. That clarity cannot be taught. It must be earned through discipline, experience, and self-awareness. The greatest strength a trader can possess is not intelligence or strategy, but composure. Intelligence without control leads to overthinking. Strategy without control leads to inconsistency. Composure turns both into mastery. It allows a trader to see the market's traps and to recognize his own. It transforms fear into caution, greed into ambition, and uncertainty into opportunity. Emotional control is not the absence of feeling. It is the transformation of emotion into awareness. When the crowd panics, the controlled trader sees advantage. When the crowd exults, he sees danger. In that calm balance lies the rare power that keeps winners in the game long after others have been washed away.